Welcome everybody to the Q1 2021 Outlook. It has been a crazy last 12 months. I don't think anybody's going to deny that one. I think we covered a lot of ground last quarter discussing all of the potential implications of the upcoming election, what it could mean for your portfolios, what it could mean for global markets. But one of the things I think I kind of touched on in that video was that I didn't think things could get any weirder. Well, surprise, they got weirder, and a lot weirder. I don't think anybody was really expecting seeing the Capitol go under siege or there to be protests everywhere, except for maybe this guy who may or may not have said that cars were going to get flipped over and there were going to be riots no matter who won, because somebody was going to be infuriated. But in any event, the markets march on. At this point, they're marching onward and upward, as they say. I'm going to discuss some new policy pieces for the new administration. That's going to be towards the end of the video, so stick around for that. There's going to be a lot of really interesting data points that we're going to touch on, and we're going to start this whole thing off with our disclosure piece, which everybody knows and loves as this is not a recommendation to buy or sell anything. This is strictly for informational purposes only. Boom, compliance piece done. Let's move into U.S. stock markets, all right? So stock markets are moving, okay? U.S. stocks have been moving in an upward trend for the better part of 6 months, but it's looking very different right now than it has over the last year, right? We saw tech shares really driving the recovery for the most part, with everybody kind of playing to that stay-at-home trade, etc. Now what we're seeing is a pretty meaningful move in small companies. They've been lagging for a really long time, but now small companies are kind of the leaders of the market. This chart right here gives you a breakdown of what's going on. We have the S&P 500 in purple, and then we have the Russell 2000 in orange. You can see sometime late fourth quarter, we started to see a major surge in small cap stocks. Generally speaking, this kind of divergence in performance makes indexers kind of sad. They don't love seeing major changes within a country's marketplace, especially because so much money has piled into the tech giants over the last couple of years. But this is really giving stock traders an opportunity to show their merit and find value where other people saw no value 6 months or even a month ago, right? I'd say that the major driver of this huge change is the reemergence of the active retail trader. That's why we see that huge spike kind of coincide with increased subscriptions to certain online trading platforms that I'm not supposed to talk about. You guys probably know what those are. It's a real thing. There are millions more investors participating in the market right now than there were a year or two ago. So that is powerful, and it kind of lends itself to that whole momentum style trade, people trying to find the flavor of the month, get ahead of it, and then jump on the bandwagon before the bandwagon crashes, if you know what I mean. We're expecting kind of a lot of helicopter money to be flying out of this administration's policy. I don't think that shocks anybody, but the run-up in the market was banking on the fact that we were going to get a bunch of stimulus. And so far, at least the rhetoric would suggest that the Biden administration is going to deliver on that stimulus in spades. We'll get into a little bit more of that later in the video. I don't want to spend too much time on it now because we're going to continue to talk about markets and data. This kind of brings me to my first data point, which is fake inflation. Not fake news, but fake inflation. You guys are probably like, whoa, Alex, what are you talking about? For all of you that aren't like real informed on how inflation is calculated and how it's reported in the data, I'm going to break it down for you real quick. Essentially what happens is the government changes the weightings of certain things, consumables, materials, whatever, to support whatever narrative they're going for. This has been going on for about 25 years in different capacities, but a really good example I could give you would be a hypothetical scenario of, let's say, ground beef versus steak, okay? So let's say the old way of measuring inflation, we had we had sirloin as the metric for consumable beef in the CPI data. Let's say for whatever reason we had a bad winter or there was a grain shortage or whatever, the prices of steak went up precipitously. Let's say it went from $7 a pound to $10 a pound wholesale. What the government would do these days, trying to artificially keep inflation numbers down, is they would then subsequently substitute that sirloin that we were discussing for ground beef, because their argument is inflation should reflect cost of living, okay? And what they're saying is if all of a sudden you can't afford steak, you'll just go buy ground beef. So it doesn't matter in terms of true inflation because people will just make adjustments in their purchasing habits. I find that to be a little bit misleading. I don't know about you guys, but once again, that's just a hypothetical that is pretty much based on fact, but still a hypothetical nonetheless. All right, so let's check out our current CPI. This is like comical for me because last week I saw Fed Chair Jay Powell speak, and he was talking about how we're not really experiencing too much inflation at the moment. He's not real concerned. You know, if it creeps above 2%, he doesn't care. He's not going to raise interest rates, whatever, right? Check this chart out. One of these numbers is the Federal Reserve's measure of inflation. I'll give you a hint. It's purple. The rest of these are major consumables. I have corn, soybeans, grain on this list. I mean, hilarious, okay? You're telling me that we are sub 2% inflation and we have these things up anywhere from 20 to 50% in the last 6 months? Like, look at the x-axis of this chart. Like, this is a really small time series we're looking at, and they're saying we have 2% inflation. This is the stuff we eat, folks. The cost is going to get passed on at some point in time, all right? So what's the point of this whole rant talking about fake inflation news? Basically, it's that the Fed isn't actually using inflation as a target anymore. If they're not going to worry about it, and asset prices, consumables, energy, whatever is just going to inflate, then we have to try to change our train of thought, how we think about things, how we think about asset prices, at least over the short to intermediate term. Generally speaking, everything comes back to the mean at some point. We get to some form of normal in monetary and fiscal policy, but there's no predetermined timetable for that. So we got to change the way that we think about things and start managing and positioning our portfolios accordingly, expecting the Fed to kind of ignore real inflation numbers. So moving on, the next most important thing that I want to bring up, and arguably should have been first, but I know everybody's sick and tired of hearing about it, at least I am, is coronavirus data. We've used this chart dozens of times over the last year, but I wanted to flag kind of some of the changes that have occurred recently. We've seen a major spike across the board in COVID data. The first line that you see on this chart is going to be our cases per day. This number is no bueno. The second line is hospitalizations, and then the final line item here is going to be daily deaths. This is really bad data, but once again, markets don't care. If you guys remember, I kind of predicted this was going to occur when we were exploring the European data back in October of last year. I was talking about how this was kind of a harbinger of things to come, potentially what we have to look forward to, or not forward to, but I guess kind of foreshadowing what our COVID data could look like a couple months later, and boom, here we are. What's this saying to us? Couple of things. Number one, market doesn't care about coronavirus, not right now. Thought process behind that is the more coronavirus issues we have, the more cases, the more deaths, etc., the more stimulus we're going to get, especially with a left leaning entire government at this point. Money is kind of no object, at least over the short term. All right, so that is a big deal, something to focus on. Number two, most important item regarding this data specifically is that shutdowns don't work. Some of the worst outbreaks have been in places where the most strict shutdowns have been. Why am I saying this? This is not a political deal. Not by any stretch of the imagination. Is the fact is that the government's going to come around to this and they're going to open up large swaths of the economy, which is going to increase demand for a lot of goods. I wouldn't say that it's necessarily pent up demand per se. I think more so it would just be getting people back to normal would increase certain activities just naturally, right? So we're going to look for opportunities in spaces that would benefit from that, especially in individual stock accounts. And then our overall macro thesis drives our mutual fund ETF accounts, and we're also going to concentrate on that. Maybe not so much that lockdown trade that everybody has talked about for the last year. We already admitted that we kind of missed the boat on some of the high-tech running stuff that had to do with lockdowns, but that doesn't mean that our philosophy can't continue to evolve and change as we improve our processes, right? So that's what we're doing right now, digging into trends and how data points can really dictate our positioning moving forward in this new environment that we're in. All right, let's move on. We're going to talk international markets. Let's go European Union. We touched on this as being a potential opportunity in our last quarterly review video. And now that we're starting to take a more forward-looking approach with these videos, I want to show you a chart here that I think is pretty interesting in terms of rate of change. I'm going way back, right? If you guys have been watching these for a long time, I used to be obsessed with rate of change. I still am. I don't talk about it as much because I've gotten feedback that people don't really care that much. But we're going to talk rate of change right now. The EU. What we have here is we have industrial production data, okay? This is an epic acceleration for a region that has been sluggish, like super slow for a really long time. COVID didn't help, but it was slow before COVID. Things were just getting less bad. Now what we have is things are getting less bad, bordering on getting good. There's been stimulus there too. They are kind of experiencing a tailwind from a debt service perspective, and then also increased demand perspective, especially from the United States and China. The biggest economy there is Germany. Big industrial production, manufacturing, and export-driven economy. The dynamics right now in terms of currency are still attractive for them. And if we just kind of use traditional valuation methods, you can always reach out to me if you want to know more about this stuff. But traditional valuation methods would suggest that this area is still cheap, to kind of use an overused phrase, relative to what the United States is like, okay, in terms of stock prices. So there's opportunities here potentially over the next year, and we're definitely looking at potential overweight here for an extended period of time, as there's a bit of a quote-unquote catch-up trade to kind of get valuations closer to where they historically trade. Moving on to emerging markets. Emerging markets are kind of the story of the year. It's finally starting to get some headlines because there was a little bit of performance out of emerging markets over the last 12 months. Normally we dedicate this entire section pretty much to China. If you guys didn't get the drift from the last video, my big issue with China is the regulatory risk side. The fact that they are essentially just a communist country that is masquerading as a bunch of capitalists makes it really hard to predict regulatory issues and risks that might arise. We've had some stocks that have done really well. We've had some stocks that have done really poorly. But in any event, I'm not going to spend the entire time talking about China. Rather, I'm going to talk about some of the peripherals and flag a couple of countries and regions that are, I guess, kind of teed up to do well in the current environment. This chart shows pretty interesting stuff. We have Vietnam, we have Poland, and then we have oil, very oil-sensitive countries. What's important about noting the oil-sensitive countries is so much of their GDP depends on the strength of oil, which not only is a supply-demand dynamic type of thing, but it's also very, very closely negatively correlated to the dollar, historically speaking. So as we've seen the U.S. print enormous sums of money, to the tune of 20% of the entire history of money printing has happened in like the last year. Give or take. That's not a perfect number, okay? So you can Google it. You'll see it's astronomical. Maybe that number's not perfect, but you get the drift of what I'm trying to say here. There's a lot of opportunity in places that have been really undervalued for a really long time that really benefit meaningfully from a weaker dollar. And the dollar should theoretically get weaker from here if all we do is print $1 trillion here, $1 trillion there, right? It's not rocket science. The thing is the emerging markets have started to do well, but there is a lot more room for them to run if the environment remains the same, which for at least over the short term, it probably should. All right, so moving on from EM, we're going to talk about what's going to happen now with this new administration, right? The election is behind us, which, thank the Lord, that was challenging, I think, for everybody, just the process of the election. I'm sure some people are super excited to see Biden in and to see Trump leave, and I'm sure some people are really frustrated about that, right? Case in point, everything that's been going on around the country the last couple of weeks. But the bottom line is it's over. Now we got to look ahead at what this means. Realistically, there's going to be epic proportions of money, epic, shot into the sky. We're talking bazooka money. They're just going to fill the bazooka with cash, and they're just going to launch it. Everybody making under $170K a year is going to catch some of those dollars, assuming they're not lost by the IRS. You know what I mean? That's a big dollar figure. The biggest issue with that is how do we fund for it? Fortunately or unfortunately, depending on where you land on this whole thing, the administration doesn't really think about that in advance. Their goal is to stimulate right now. And so we have to be adaptive in our thought process. We don't have to think 5 or 10 years down the road on what it means to have this much extra currency pumped into the system, all this excess liquidity, devaluing the dollar, extra debt, etc. We don't have to worry about that right now. What we have to do is figure out how can we make some money based off of the game that we're playing, and the game we're playing is a highly liquid, highly stimulated, highly leveraged environment. Okay? Realistically, trying to think a couple steps ahead, they are going to have to pay for it. So at some point this year, there's going to be some kind of tax reform. I would guess the first thing that's going to happen is there are going to be some rollbacks of the Tax Act of 2018. President-elect Biden, I guess President Biden now, by the time you watch this video, has already said that he's not going to raise any taxes on anyone making over $400,000. Okay? While on paper, he's probably telling the truth that he's not actually going to raise the marginal rates, what's going to really happen, or your effective rates are going to go up in some capacity for most of the population. That's because there's going to be some adjustments made to deductions. There's going to be a pretty meaningful increase in corporate taxes across the board. And we don't really know kind of where the whole state and local tax deduction piece is going to come in. We would also expect that for the mid to high earners, they're going to have a little bit of a harder time saving into 401ks, so getting that deduction. There's also going to be some potential issues moving forward with how taxes are actually managed with all of the uncertainty, especially around the framework of capital gains. Okay, this is going to be a big one. If you're making over $400,000 a year, your capital gains rates are probably going to go up. If you make over $1 million, they're going to go up a ton. We're talking potentially, this is all speculation because there's no policy in place yet, but potentially over 50%. If you include all of the surcharges and everything else, including state taxes, depending on where you live. So that's a big deal. It's going to change the way people trade a little bit. It'll probably create some pressure on the market at some point this year as people try to lock in gains from way back. This is all speculation, but realistically, they got to come up with some dollars to pay for all of this stimulus. Couple of stimulus items. We have a bunch of checks getting mailed out. The idea is to add on to the most recent stimulus package passed in December, add another $1,400 to that. Another piece to this, probably a core piece to this, is extending unemployment to September 1st, I believe, is what was released by Biden last week. And the president has suggested that the weekly benefit from the federal side, or at least the supplement, is increased by $400 a week, all the way to September 1st. So that's going to be weird for labor markets, all right? There are causes and effects to every dynamic. There are repercussions for choices that are made, and by raising corporate taxes, dramatically increasing the minimum wage, and then also changing unemployment benefits to kind of make it more attractive to stay unemployed, hypothetically speaking, if that's the person's mindset, it's going to be really, really weird. They're increasing the cost of doing business and then also narrowing the existing labor force. So those 3% unemployment numbers that we saw right at the beginning of last year, I don't think I'm going out on a limb here saying that very realistically, we could never see those numbers again, or we may not see them for at least 10 years. That's just my prediction. But full employment used to be 5% unemployment, right? And then that number dropped to 4 and 3 and then slightly below 3. This is a different animal right now. Higher cost of doing business, significantly bigger taxes, higher minimum wage, and a demographic that isn't drastically increasing in overall net worth across the entire spectrum. So that means spending is not going to be up long term, even though we're going to see a huge burst in spending with all of this stimulus over the short term. So those are the new pieces. I think that the administration really has the country's best interests in mind at the moment. But I feel like it's fairly short-sighted, at least in terms of the way the macroeconomics are going to view this whole thing when we're sitting here 3 or 4 years from now looking back. That doesn't mean markets are going to crash. It doesn't mean markets are going to go through the roof. What it means is some sectors are going to do great, some are not. So we have to position ourselves for that and be forward-thinking in our thought process to the best of our ability. With all of this data, if we put it all into a blender and then pour it out, what are we going to get? We're going to get our general positioning, right? As always, you guys know the drill. Data dictates positioning for us here at CFG. It's a big deal. It's never going to change. We are very data focused, but we can always change how we use the data. This is what I was kind of alluding to earlier. What's going on right now has never really been seen before. We've never seen this much government intervention in anything, ever, for any government in modern history. So we have to evolve constantly as the rules are changing. I don't love playing a game where the rules change all the time, but the bottom line is that's what happens, at least right now, right? So we're going to evolve. What does this mean for the portfolio strategy? First and foremost, we're going to underweight U.S. equities a little bit. We have been on a relative basis, comparatively speaking to where we've been in the past. We're changing our U.S. equity exposure just a little bit. And keep in mind, this is pretty much across the board. It depends on your personal risk tolerance, type of portfolio strategy you have. But these are all generalities and kind of what's happening across the entire portfolio spectrum for us in terms of strategy. We're not necessarily making that change to a bunch of small caps like they're talking about on TV. What it is we're being a little bit more careful on our exposure to what everybody else owns. Right? This is how we kind of gain an advantage over the long term on a risk-adjusted basis. We are dynamic in our overweights and our underweights, okay? Internationals, that's an overweight. This is a story we've talked about now for a few months. It's going to remain an overweight into the foreseeable future. Obviously, I reserve the right to change my mind. But on the margin, we have more international, developed international investments than we have in the past. Emerging markets, also an overweight. I think I outlined the case for that pretty clearly. The biggest one on this is dollar strength. And then we also have still the fear and the risk associated with emerging markets, and people are still nervous that the vaccine isn't going to get there fast enough, things like that. So there's opportunity there. Which weighting you're going to have in your portfolio completely depends on your risk tolerance. But overall, across the board, we have some kind of emerging markets exposure in all of the diversified portfolios, and it's a little bit more than usual. Fixed income, that is less. That's an underweight. Thought process here is we've seen increased interest rates pretty much across the entire yield curve over the last few months. It's our expectation that it will at least stabilize where it's at, or it will increase. We're also expecting the yield curve to steepen, which means the short end of the curve, or the shortest maturity, is going to stay around the same, and the longer end of the curve, the interest rates are going to go up more, so it's going to get steeper. Okay, when that happens, certain sectors do well. But one thing that we know is long-dated bonds, when the interest rates are going up a lot, they don't do that well. So we're underweight bonds a little bit, and we've changed the type of bonds that we're investing in across the board. We still have our core holdings. It's just not as much as it was a year ago, for example. All right, so that's all I have for you guys. I hope this was super interesting. I'd love to circle back and talk to any of you, answer any of your questions here in the short-term future. We have appointments available for reviews, so if you guys would like to get together and have a review, reach out to our office or shoot me an email directly. If you're not a client yet and you're watching this video and maybe this is your first experience, you want a portfolio review or just to talk about markets, whatever, I'm open. There's no charge for a consultation. You can reach out at info at cfgfinancialplanning.com. We also have a ton of resources on our website, www.cfgfinancialplanning.com. Awesome videos. We got all of our archives up there, blog posts, good stuff all over the place. So check that out. Once again, I'm so grateful for you guys watching the video. I hope this year is amazing for everybody. Stay healthy, stay happy, and remember, hope is not an investment strategy.